Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance, and today we're diving deep into loanDepot's latest financial report. Get ready because this one's a wild ride with some interesting ups and downs. Before we jump in, if you appreciate getting straight insights from these SEC filings and want to stay ahead of the curve, make sure you are subscribed to the channel. Also, join our Discord community linked in the description below for more exclusive content and discussions. So, loanDepot Inc. has just filed its quarterly report for the period ending the 30th of September 2025. And like always, we're going to cut through the jargon and get to the heart of what it all means for the company and its investors. Let us start by looking at a snapshot of the company's financial health, their balance sheet on the 30th of September 2025. Total assets now stand at $6.2 billion, a slight decrease from $6.3 billion at the end of the previous year. On the flip side, their total liabilities are around $5.8 billion, also a small decrease. What this means is their total equity, which is basically the owner's stake in the company, has seen a dip from about $506 million to $433 million. That is not a great sign, showing that the value belonging to the shareholders has decreased. Now, let's talk about the profits, or in this case, the losses. For the 3 months ending the 30th of September 2025, loanDepot Inc. reported a net loss of $4.9 million. This is a significant shift from the same period last year, when they actually made a profit of $1.4 million. Looking at the longer 9-month period, the net loss widened considerably to $40.2 million compared to a loss of $65.1 million in the prior year. While a smaller loss is good, the fact remains they are still losing money. Investors will want to see a clear path back to profitability. This particular line item, gain on origination and sale of loans, net, is pretty important for loanDepot. It basically shows how much money they make from originating new loans and selling them off. For the recent quarter, they reported a gain of $201.3 million, a slight increase from $198 million last year. Over the 9 months, this figure also saw a healthy jump from $481 million to $542.5 million. This part of the business seems to be doing well, which is crucial given the overall losses. Now, here is an interesting point. Their servicing fee income, which is income generated from servicing existing mortgage loans, has decreased. For the quarter, it went down by about $12.4 million, or nearly 10%. Over the 9 months, the drop was even more significant, down by $49 million. This decline is attributed to a reduction in the overall size of their loan servicing portfolio, likely due to selling off some of these servicing rights. Less servicing income means a smaller, more stable revenue stream. Let's talk about costs. Their general and administrative expenses saw a massive jump of over $22 million in the most recent quarter. This large increase is quite eye-catching. The report mentions this is mainly due to a $20 million insurance claim receivable related to a cybersecurity incident in the previous year. While the incident itself is a negative, the way it impacts the financials can be a bit confusing. It looks like in the prior year they had a big expense related to this incident, and now they are reporting a recovery. It is important to understand if this is a one-time effect and what the underlying operational costs are. Personnel expenses, which include salaries and benefits, have edged up by about $28.7 million for the 9-month period. This rise appears to be linked to increased commissions and salaries, but it is somewhat offset by a reduction in equity compensation. While they have slightly fewer employees this year compared to last, their payroll costs have gone up. This sometimes happens when companies retain key personnel or pay out higher bonuses despite a slight reduction in workforce. Looking at the balance sheet, total assets have decreased slightly from $6.3 billion to $6.2 billion. This is largely driven by a drop in loans eligible for repurchase, which fell by about $78 million. And as we touched on earlier, the total equity has decreased significantly by about $73 million, signaling a reduction in the net worth of the company available to shareholders. This decrease is primarily due to the reported net losses and share repurchases. From a Warren Buffett perspective, shrinking equity usually means the company is not growing its intrinsic value for shareholders. Their liquidity situation shows a substantial availability under warehouse and other lines of credit, with about $1.8 billion in additional availability. This is a crucial lifeline for mortgage companies, as it allows them to fund loans before selling them. The company has about $2.4 billion borrowed against these lines, with a total capacity of $4.2 billion. This access to credit is vital, especially in a fluctuating market. Debt obligations have increased to over $2 billion from about $2.03 billion. This rise is mainly due to new term notes issued and a decrease in MSR debt. It's always worth watching debt levels, especially when interest rates are high. The company also detailed a significant cybersecurity incident that occurred in January 2024, while they've taken steps to address it and are working with regulators. The aftermath includes ongoing class action lawsuits. They reported receiving $15 million in insurance reimbursements and expect another $20 million. This incident and its fallout, including settlements and potential future costs, remain a key area to monitor. Another significant point is the securities class action litigation that was filed following their IPO. While a settlement was reached and approved, there was an appeal. Thankfully, the Ninth Circuit affirmed the settlement approval in August 2025, bringing some closure to that matter. They are also facing a class action lawsuit related to the Telephone Consumer Protection Act, alleging they sent pre-recorded calls without consent. This lawsuit was certified for class action status in October 2025, and the company believes it has strong defenses. Looking at the bigger picture, loanDepot is operating in a historically challenging environment with rising and then slightly falling interest rates impacting loan volumes. The fact that their core business of originating and selling loans is showing growth, particularly in margins, is positive. However, the overall net losses and the decrease in shareholder equity cannot be ignored. The company seems to be navigating these challenges by focusing on operational efficiencies and strategic growth initiatives, but the increasing personnel and administrative costs, coupled with the lingering effects of the cybersecurity incident, present headwinds. One of their strengths appears to be their ability to secure substantial credit lines, which is critical for survival and growth in this industry. So, what is my take on this report? loanDepot is clearly in a tough market, but they seem to be holding on, especially with their loan origination and sell segment showing resilience. The increasing gains on sale is a good sign they are making smarter deals. However, the decrease in servicing income and the shrinking equity are concerning. They need to not only manage costs effectively, like keeping general and administrative expenses in check beyond the one-time insurance recovery, but also show a consistent path back to profitability. The ongoing legal battles, especially the TCPA and TILA cases, could also pose future financial risks that are hard to estimate right now. For investors, it is a wait-and-see situation, keeping a close eye on their ability to translate sales volume into sustainable profits and manage those rising costs. Alright, that's our deep dive into loanDepot's latest financial report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button and subscribing really helps the channel grow. And don't forget to check out our Discord community linked in the description for more exclusive content and discussions. Thanks for watching. See you next time.